market participants. And so I'm not a big fan of this, but several of the people I'm interviewing are throwing these terms. And so you will not get tested heavily on this. But if you're going to stick out that term, you should know what it is about. And so mutual fund and hedge fund. Sometimes small investors, we don't understand financial statements. We don't understand P&L and balance sheet and EPS and EBITDA, why the stock price should be high, why that should be low. But we want to invest in the stock market. Several people have told us that, hey, this is an interesting thing, you should be invested, the returns are very good. So we'll say, okay, I can't invest, I can't select which stocks to pick. I'm going to give it to my good friend there, who's a good investor, sharp guy. He'll take 1%, but the rest will come to me. Now, that sharp guy says, I'm not going to collect money from only one pie. I'll collect it from 100 guys. I'll invest for all of them. I'll give them their returns, but I'll collect some 1%, 2% for the act of advising them or building their portfolio or governing the investment decisions for them. And that's a model which got built and got evolved and got formalized as mutual fund. So each person gives 1 lakh, 2 lakh, 3 lakh. 4,000 people subscribe to that. The mutual fund has 3,000 crores to play with. They invest that 3,000 crores and generate interest, generate income, generate profits, generate stock price improvement. They take a cut for themselves, give the remaining back to their people who have invested with them. That is a model of mutual fund. Mutual fund industry is regulated. The mutual fund guys cannot then say, okay, I have 3,000 crores with me. Stock markets are good. But pata hai kya, there's a beautiful building coming up by this builder in Bangalore. I'll go and buy 5 flats and resell them 1 year later. They can't do stuff like that. They can't invest in real estate, jewelry, options, currencies. They can say they can invest in stock markets, nothing else. Who can invest and do more funny stuff? Hedge funds. Hedge funds have a broader mandate. Mutual funds hold stocks for 1 year, 2 years, long term. Hedge funds can do intraday trading. They can short a stock. They can sell before they buy. They can buy deals in options and futures. They can do all kinds of stuff because they have full freedom. So the government says, if you're a small investor and you don't understand this, you invest in mutual funds. If you're a hedge fund guy, don't make a pitch for the small investor. Hedge funds are the guys who run large portfolios for large pots. So if a guy has sold his company, he has 200 crores and he gives away 100 crore for somebody to run his portfolio. And he says, look, I need returns. I'm not worried about risk that much. I understand this. Take your calls. He'll put with a hedge fund. A guy on a monthly income who wants to set aside 6,000 each month will put in a mutual fund. Mutual funds are heavily regulated. They have a strict mandate. They hold for longer positions. Hedge funds is the Wild West. They can do whatever they want. They can do day trading. They can close positions really quickly. They can short a stock and then buy it later. All kinds of stuff. And private equity and venture capital. These govern investing in companies that are not in market. When companies start off small, they have a garage operation. They have a good idea. This guy starts a restaurant. One friend manages the customer. The other guy is a master chef. Then they expand. They have 5 outlets. Then they take money from friends and family. Then they expand into one city, cover 6 places. Then they deliver. Then they realize that they have a fabulous idea, fabulous brand. They take in some money so that they expand into 7 cities. That is when they'll say, hey, why don't you put some money into my venture? I have a beautiful business idea. Put it. These guys are not large enough. They're not sound enough. They don't have a financial predictability to be in the capital markets, to be listed in a stock exchange. But they have a fabulous business model, compelling proposition, and attractive investor avenues for several people. Who are those several people? Venture capitalists and private equity guys. Not much of a difference between them. Don't stick your neck out and say this is how they are different. They're broadly the same, especially in the way they are operating right now. Venture capitalists, broad thumb rule. Sometimes it's said that they get in earlier. And private equity. Why is it called private equity? The equity is not listed. It's not in a market. Someone privately guy who owns a company, another guy comes and privately buys equity from him. It's not listed in the market. That's why it's called private equity. So not much of a difference. In venture capital, you have seed A, Series A funding, Series B funding. You have angel investors, all that. More jargon, nothing more than that. These deal with listed, large, more predictable companies. These deal with ventures, startups, business plans that need backing before they see a certain size. Right? We're going into classic jargon territory. Several terms, what it means. IPO. IPO is initial public offering. So a company, you have a brilliant idea. You sit with a friend and say, hey, let's make a business out of this. You do a business for a year, 1 year, it works really well. You quit your jobs and say, let's take it forward. We'll recruit 3 more guys. And then that works. You break even, you start making money. Then you tell your friends and family, hey, I'm onto something. I need 15 lakhs. 3 of you put in money, we'll grow bigger. They give money, you grow bigger. Then you feel like, look, I am chomping at the bits, but somebody can give me 1 crore, I can go into 4 more cities. You go call an angel investor, gives you money. Next time you say, I need 5 more crores, I can be national. You call on a venture capitalist, he gives you money. You're national, big, growing, steady. Then now you feel I'm of a certain size. Now I can actually say I'll be a listed company. Then you do an initial public offering. Then you say I'm getting listed. From now on, anybody and everybody can hold my stock. I'm selling a part of my company so that small investors can all buy 10 shares, 100 shares, 1000 shares. So several owners, distributed ownership, listed on an entity. That happens after you do an initial public offering. LBO, it's actually a weird term, become popularized because it appeared in some movies. It's a leveraged buyout. So one company can buy another company. So there is one company which is large with an interesting play in one sector. We frequently hear this. They bought this company. They bought that company for this valuation, that term, for strategic importance. Sometimes a company can be bought by paying cash. Sometimes a company can be bought by borrowing money. So I am a big company, company A, large. I have 1,000 crore turnover. I'm doing well. There's another company that has 100 crore turnover, but they have to offer some very big sweet spot that is useful for me. But that company is valued at 500 crores. So I don't have 500 crores just like that with me. I go to a bank, borrow 450 crores, give 50 crores. With that leverage, with that much debt, I buy the company. So making an acquisition funded not by cash that you have, but funded through cash that you borrow is called a leveraged buyout. PE is price to earnings ratio that you've already seen. This bull and bear. Somebody who's bullish on the market is the guy who thinks it's going up. Next, you buy, it will go up, it will go higher, it will go higher. Is optimistic about future. The share prices will go up. A bear is someone who says, yeah, it's going to crash. And so every market participant has bulls and bear. There are lots of bulls and they have sway and their optimism wins. Share prices will go up. A lot of bears and their pessimism is grounded. What they have carries merit. And the companies are actually not performing that well. The market will crash or come down. Right? NPA is a non-performing asset. This is a terminology related to banking sector. That's important. Banks send out loans. Right? So they give out loans and they expect interest payments on them and they expect repayment on them. So if they give loans and the repayment does not come, then it's called a non-performing asset. And so I lend out to some guy and he builds a house and then he goes away, he doesn't pay me the loan back. It becomes a non-performing asset. So technically, a loan that is not serviced for 90 days gets called an NPA. And that's a marker to say, hey, this the time where you can roughly say it's not a hiccup. He doesn't plan to return this. There's a question mark on the asset itself. It is a dicey asset. It's a non-performing asset. Obviously, if a bank has a loan book of 1,000 crores and of which 200 crores are looking iffy, the bank itself is in trouble. So if an NPA, non-performing asset proportion or percentage keeps on increasing, then you're worried. As a banker, you're worried. As a central banker, they'll be worried. So banks' NPA is a very crucial metric for them lending out more, for them be having a viable future, for them recognizing profits, because only when repayments come, they can confidently book profits. Recession technically is 2 consecutive quarters of GDP decline. So 2 quarters where GDP has gone down, you have a recession. Recessions don't get called early. It's a hugely scientific, laborious process to time and mark a recession. And so when you see India is entering a recession in the press, or India will enter a recession 3 months later, 4 months later, it's all predictions. Several recessions get dated only after, post facto. They say the country entered a recession from 2003 August to 2004 January. They'll be able to say that after 6 months after the recession ended. And it's very tough to call out a recession. But generally, when the mood is not good, we talk about a recession. Technical definition, 2 consecutive quarters of declining growth. V-shaped recovery. For some reason, the economy crashes. There's been an earthquake, there's been a short-term war, there's been a pandemic, it crashes. But this is clearly short-term and does not leave long-term implication. The moment that overhang is removed, it bounces back. So it crashes and it bounces back. V-shaped recovery. There is an L-shaped recovery. You know what it means? There's a crash and doesn't bounce back. So it's just not rocket science. It crashes, bounces back immediately. It's V-shaped. L-shaped, it doesn't jump back. FDI and FII. Both are foreign investments. FDI is foreign direct investment. FII is foreign institutional investment. What does it mean? We often hear foreign direct investment of 49% has been allowed in this sector, 74% has been allowed in that sector. Foreign direct investment is if money from abroad comes into India to form an asset in India and build something in India, and that is FDI. If Nokia comes and sets up a factory, if Tesla comes and sets up a factory, that's FDI. If Apple sets up a factory, that's FDI. They bring in money and create an asset in India and have continuing operations in India. Foreign direct investment. Foreign institutional investment. Foreign institutional investor is someone who says, hey, I'm buying stock. I'm buying a bunch of $1 billion worth stake in Maruti. That means the money is getting transferred into ownership, but of an already existing asset. So it's a financial transaction. Money is coming into the country to take ownership of stock, buying it from someone. That is FII. Money going into building a direct asset. That is FDI. Technically speaking, broadly for an economy, FDI is very useful. FII is also useful, but FDI is when knowledge transfer can happen. Best practices can come in. You can actually have modern factories coming in. Somebody has a stake in that economy in creating a factory and providing continuing employment to the people there and building and growing with that economy. That is FDI. FII guy takes shares. Next day something happens in the US and some bad news happens, he's going to exit. And your stock market can become vulnerable because FIIs exit. Very often their entry and exit are not determined as much by local economic conditions as they are by his own constraints back home. Something iffy happens, he wants to take money back. And that might not have anything to do with the Indian economy. So FDI is technically better. But very often we talk about rules for FDI and not so much for FII. More terms, more jargon. Right? What is ROI? Return on investment. And ROA is return on asset base. Right? What is a repo? Repo is repurchase agreement. Repos, basically banks need continuously run short of funds on a daily basis. It happens. So because they cannot balance their loan and deposit book on a day-to-day basis. Suddenly they might get 100 crore guy who says, look, I want to borrow 100 crores from you. They'll give him. And then they'll cover this position by borrowing from the central bank. In borrowing for this, they give government securities as like security. Like you borrow against a house, they borrow against government security. Even that overnight borrowing or very short-term borrowing is at a rate. That rate is called the repo rate. The rate at which banks can borrow from the RBI is a repo rate. Right? Short squeeze, we'll come to that. Fundamental analysis, the analysis that I told you, which was think about a company, their base, how much profits are they making, how much cash flow are they making, how much cash flow are they making this year, what can we project that they'll make year after, the year after, and then year after, 10 years out, 15 years out, how we discount that, what is the discount rate we use, how confident are we about our assumptions, what are the different scenarios, and then adding up to the net present value, finding the enterprise value, subtracting the debt, recognizing what is the equity value in this, and then finding the share price from first principles by projecting, valuing the asset and simplifying. That is fundamental analysis. What is technical analysis? I look at the share price. It is going like this. I look at this and say, okay, several people got excited at this point and then it bounced up and went. So psychologically, this forms a bar. If that has been breached, that is the time for me to buy. So it is behavioral. It is pattern driven. It is based on the share price graph. Several day traders look at graphs and say, okay, it's going to. So they don't care about what the company is doing, what is the news driving this. Maybe they'll keep an eye on the news, but they care not about forecast, but the patterns in the graph because they believe that the behavioral patterns get repeated. So it didn't go beyond this point. That means there's a floor there. Below the 40 rupee points, several people think it's valuable. Today it has gone to 38. It's going to rally sharply. That's what the graph is telling me. Buy. So they look at how the graph is moving rather than projections about the companies. Several important guys do both. Some swear by this, some swear by this. Okay. Short squeeze. It's an exceptional term, not that frequently used. It is topical now. And you go long a stock. That means you buy the stock and you own the stock and you want to sell it later on. And then when markets developed and evolved, they created this idea of shorting a stock. What it means is you sell a stock without even having it. And it seems like a weird idea. I have a chocolate. I buy chocolate from a trader and I sell chocolates 4 days from now. I make profit. We all get that. How would it be if you could sell 10 chocolates and then buy them later on? It doesn't seem like it is possible. It doesn't seem like there is even a common sense proposition. Whereas in stock markets, it is possible technically to sell a stock, to short a stock that you don't have. When will you short a stock? If you think the stock price is very high, you say, I'm selling it. I don't have it, I'm selling it. It's at 70, I don't think it's worth even 40. I'll sell it. I'll sell at 70. When it comes to 40, I'll buy it. So technically, this is possible by saying, hey, I'm selling at 70 by borrowing the stock. I borrow what I don't have and I sell it. And then I buy. So you can short a stock, you can go long a stock. Why is shorting allowed? The prices go very high. The participants need to have a mechanism to say, I think the price is too high. Okay? And giving the freedom to short a stock gives liquidity. If somebody is there to sell, then the guy who is interested in buying has an avenue to buy. So having short in market is useful. But what happens is sometimes guys aggressively short stocks. They short it left, right and center. And then the price has to come down for them to be able to buy back. They have to buy. If they don't buy, then they'll have to borrow. They'll have to borrow at current prices in order to have the position. So you cannot short a stock, you cannot sell the stock today and then say I'll buy it a year from now. Doesn't work. You have to cover your short position. So sometimes what happens, bunch of guys short stocks. So many of them short stocks that so many sold out positions are there for the stock that stock becomes completely unavailable. So the fundamentals and what is happening in the company, what is happening in the industry economy, they all become separate. It's like saying suddenly somebody has said I'm selling 25 chocolates. This guy says I'm promising selling 40 chocolates. I'm selling 70 chocolates, selling 100 chocolates. There are 5, 10 guys who have sold chocolates. They promised to sell it. They said by 2 hours from now we'll do. They're all thinking I'll go to the nearby shop, buy it and then give it to them in the evening. But right now I'll sell. Right? So they all want to buy from the same shop. That shopkeeper has only 120 chocolates. The totally 500 buys 500 chocolates that have been promised to be sold. So they have sold it, they'll deliver it. Right? So they go, this shopkeeper doesn't have, I'll go and find another shopkeeper. They find another shopkeeper who has 150 chocolates with him. But by this time, the news has spread. There are 4 guys who have sold. They're scrambling to buy. That shopkeeper says, all good. I have 150 chocolates. Usually I sell at 1 rupee, for you 150. And by that time, the first guy who sold, who said, I'll promise 120, he said, sir, chalk nahi hai. I can sell it to you, but I need 175. News spreads and slowly the price at which these guys have to cover and deliver keeps increasing. So they short the stock thinking it's good news to sell it at that point. But because they are scrambling to buy and cover and deliver on their short things, prices go up higher and higher. That's a short squeeze. That's what happened with GameStop. You get a promise, they shorted the stock, they thought they could cover it. By that time, they could go and buy it from some people who just have the stock, they don't even realize what is happening, they don't care about it. Some guy borrows it from them, they make some small spread on it, they cover their positions and play their game. They didn't mind it. But bunch of guys got together and said, there's a heavy short position on this stock. We'll all buy this stock now and drive the prices up. These guys will struggle to cover it. We'll drive them into losses and convey that don't let these guys cover their positions. So every person who had the stock said, oh, I would love to lend it to you for a week so that you can cover your position. But hey, tell you what, the price is at X, I want 1.4X. They kept on bidding the price up. So the stock that was heavily heavily shorted stock, that means it is bearish, the outlook is not good. The price went up higher and higher because these guys didn't have stock to cover their position. That's called a short squeeze. It's not a crucial term. It's an interesting term now, thanks to what's happening with what happened with GameStop. Just to reiterate, it's a starting point. And so if you're going to stick your neck out and say, I understand this, I like stock markets, I want to invest, do tons of reading. The profit and loss, cash flow, balance sheet, you must know. Very crucial. If you're going to say, I am actively involved in share price, then you need to know fundamental analysis, technical analysis, P ratio, what is the market ratio. If you say, okay, I'm a math guy, I like the math behind how stock prices behave, you need to understand risk premium, risk-free rate, beta, all of that. So the pressure on answering these questions is higher. One, if you are a finance grad, if you're a chartered accountant, you need to know all of this. You should look at this video and say, it's unlikely to be something that I don't know. I know my stuff. If you're a BCom grad, you should know most of this and you should be comfortable speaking the language. If you're not any of this, not an economic grad who's learned some accounting, if you're an engineer who says, I'm interested in this, then learn lots of stuff. Because even if you're saying you're interested, you need to have a sound grasp of whatever it is you're claiming that you're interested in. Next step, I find several students throwing these terms about without knowing what they are. Any term you venture out, you must know the meaning for. If you're saying I'm interested in finance because I like the idea of how mutual funds operate. Bam, mutual funds, you need to know that stuff. I like the idea of how hedge funds operate and how they are different from mutual funds and more exciting. 2 terms. I want to be in private equity later on. Bam, you need to know. So every time you throw the terms, you need to know the background stuff for it. So use this as a good starting step, but it's not the end step. Right? Wonderful, guys. Best wishes for your interviews.